Hi, this is Matt McAleer, Director of Equity Strategies at Cumberland Advisors, just after the close on April 26th. We spoke last week about some of the movements we've seen the last 6 months in fixed income, and I promised to have John Musso on. So we're going to jump over to John in 30 seconds or so. Just a quick wrap on the equity markets this week. Fairly solid bid throughout the week. Nice breadth, small cap, mid-cap core indexes, and S&P 500 all up over 1%. Strongest areas in our portfolios were healthcare. We talked last week about the weakness in healthcare off of some of the political jawboning going on. We started to see that bid last Friday afternoon come back into healthcare. Specifically spoke about IHI, one of our holdings, traded to 211 midday last Friday, got a bid, closed around 214, had a nice week, up almost 4% this week. Laggard this week, energy, another sector we talked about last week. We've been battling that position. We've had a good run in it this year. We had a little pullback, 1.5% across the sector this week. So we'll see what next week gives us. Good breadth, equal weight, keeping up with cap weight. It's something we like to see. Last week I talked about bringing John on because we always like to go to our hot hand. If you remember last November, 10-year Treasury was getting up towards 3.25. John said, we're buying all we can. We're extending duration. We like these yields. We like a 4.25 tax-free muni. When rates 4 and 6 weeks ago started falling, got down to about 235 at one point, right, on the 10-year, John said, we've become a seller of some of our bonds here. Not all, just trading around the momentum that was coming into the market. So John made some key sales there. I wanted him to try to talk a little bit today about how he focuses on interest rate movement and what he sees over the next 6 or 12 months.
Thanks, Matt. I think it's really important to look at the last couple of weeks through the lens of the fact that we just went through a tax day last week. What that has meant is that on the municipal bond side, many people have started to refocus on their need to own tax-free income, a way to shelter income away from taxes. Because most people ended up paying more in taxes this year, even though tax rates are lower, and a lot of that is due to the SALT provisions of the tax bill, where state income taxes, local property taxes are no longer deductible. So in high tax states, it meant a much higher tax bill for some folks. So what you've seen this year is a voracious demand for bonds in high tax states like California and New York. But in general, you've seen good demand for municipal bonds across the whole yield curve. And what Matt was talking about with yields coming down this year, it's true. The 10-year bond yield, which is now hovering somewhere around 2.5%, give or take, had been as low as a 235 and as high as a 325 last fall. Those rates have dropped. They've taken muni yields down with it. Muni yields have dropped even further because I think people realize their need for tax-free income. What really hasn't fallen too much is inflation. It's been very well behaved. And so what that means is the real yield, the difference between the bond yield and inflation, has gotten much narrower. Hence our reason for some of the defensive moves that we've made in portfolios. Not the lunatic fringe, just bringing in bond durations somewhat to be a little more defensive. And why is that? Well, number one, we're not getting paid as much on an after inflation basis for owning intermediate and longer bonds. And the second part is that when you look at a GDP number today that was 3.2, higher than expected, if you start to push that out, and if we stay that way for the rest of the year, the idea that the Fed is on hold for the rest of the year, you might be able to put that aside, and they could surprise the markets with a rate hike. So they've been very good markets from the demand side. Supply has been down, particularly in municipal bonds this year, partly because of the tax bill, and demand has been up. And given the movements in the market, we think it's time to play a little defense.
Thank you, John. So we often talk about movements within the equity markets, among sectors, among indexes. I thought it might be interesting to just hear from John today, and I was happy to have him in, how you can move your buying and selling within the fixed income market as well to try to take advantage of rips in yields and pullbacks in yields. So I hope that was helpful. I have a special treat for you next Friday, leading into one of my favorite weekends of the year, John's as well. I'm going to have my Kentucky Derby pick for you. It's one of my favorite weekends. We have the Kentucky Oaks on Friday. Won't have a pick there because this video will be out after it's run, usually about 5:30. Then a full slate of stakes races on Saturday at Churchill, followed by the granddaddy of them all, the Kentucky Derby. Have a great weekend. We'll see you next week.
Thanks, everyone.